We've talked a good bit about stock already in class, but we haven't really talked much about the mechanics, the arithmetic underneath the valuation of it. We talked certainly about IPOs and how those come about, and underwriting, and choices on capital structure, and the motivation of stock and why it's different as an ownership structure of corporations than, say, small businesses that have no stock. So we've certainly talked a lot about stock to date, but we haven't talked yet about kind of the nitty-gritty mechanics of stock valuation. So that's here what this presentation's emphasis of. As always, the goal here is to give some distilled view of some things that are particularly important for grades, right? Give you some hints on things to really be leery of when you're doing practice problems and such, as well as there are some concept items that we'll use to ask about stock valuation. In many of those cases, it's actually just kind of asking in words what the mathematical mechanics are underlying the work here. But say, the goal always is of presentations is to try to provide a distilled version with some highlights towards better grades, save you some of the effort of trying to digest a 30 or 60 or 90 page chapter sort of thing. So talk first about preferred stock, which is a hybrid type security. When I say hybrid type security, it's a mix between stock and bond in terms of its characteristics, right? So, right, a bond has set coupon payments, but they're not just set as a matter of practice, they're set by law, right? They're mandated, right? You have to repay them. Right? And so because of this, a bond is less risky for the investor, right? Point of view. Right? Common stock doesn't have set coupons. We're going to talk more about this here, obviously, with valuation in a moment, right? They have dividends as a way of distributing cash flows to investors, right? And they typically grow, right? But they're not mandatory. You don't have to pay them at all as a stock. You have this implicit expectation that you will, and if your shareholders really want them and the firm doesn't deliver, they might do things like have a proxy fight and oust the board. We've talked about, again, some of those qualitative, conceptual type items before. But the dividends are not mandatory, right? This is the most risky kind of endeavor. Most risky for the investor, right? You have the highest priority for your bondholders in case of default. Highest priority in default. This is the lowest priority in the case of default. Okay. And in between is preferred stock. A lot of companies don't even issue preferred stock. So we'll say we do a number of examples and such where companies only have bonds and common stock or debt and common stock as part of their capital structure. Preferred stock doesn't always exist for every company. A lot of them don't have it, right? They have dividends. They're called preferred dividends, but they don't grow. They typically are flat. They don't grow. If a preferred stock is issued with a $2 dividend per year, it's usually $2 forever, $2 next year, in 5 years, in 20 years. They don't grow the way common stock dividends typically are. Right? The dividends are still not mandatory with preferred stock. They're not contracted by law or anything, but they take priority over common dividends. You're not allowed to issue your common dividends unless you pay your preferred dividends. Okay. So this is the medium risk and medium priority in the case of default would be having some value for your preferred stockholders. Now, mathematically, when this works out, it actually makes the valuation of your preferred stock somewhat easy, because when your preferred stock has a non-growing, a flat dividend where it's just the same amount over and over and over again, well, the math becomes a lot easier, like the coupon portion of a bond where it's the same exact interest rate payment, a coupon paid over and over again. Now, say, well, we say, again, we have all this stuff here about, again, you can omit your dividend payments on preferred stock, right? So you don't have to pay them, they're not mandatory. But if you don't pay them, then you are not allowed to pay your common stock dividends until you've caught up. I might even write that down with you here as well, right? But the preferred stock, I always kind of like to think of it as the meter is running, right? The meter's running, like on a taxi cab, with the idea being if you don't pay your preferred, they're not mandatory, but if you don't pay them, they don't just go away, right? They aggregate. So if I miss my $2 dividend 3 years ago and 2 years ago and last year, I have $6 of old dividends plus this year's two. I have to pay all those before I can pay my common dividends that I would like to pay. Right? And that's what I say. But they're still not mandatory. You can't be sued or anything if you fail to pay them like you could from your bond investors. But that's why they're this hybrid type security. If you think of that mathematically, because the preferred dividends don't grow, they're just the same amount over and over and over. That's the reason we often write this out mathematically as just D. D, 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 D. There's not even any subscript for it because the dividend at time 1 or 2 or -7 or 17, it's always the exact same amount with preferred stock. They don't grow. So just knowing what the amount is, the dividend in the numerator, is enough to make the math work. If you have a $20 dividend, right, every year forever, and the rate is 13%, that's literally just the case of taking your, right, good old, right, let's cancel that, sorry. That's literally just a case of saying periods, make it a huge number, right? And if you have a 13% interest rate and your dividends are $20, right, what's the present value of this thing? Right? Well, I went too far the first time there. Sorry for the slip up. Say I had 50 of these $20 annual dividends. It's $150, $350. What if I up it to 70? Right? See, as I get further and further into the future, how about 100 years of these dividends? The value doesn't move much anymore, right? Do 500 years, maybe even, of these dividends, right? 153.85. Well, that matches if you go to your calculator. If you just divide 20 by 0.13, right, you'll get that number of 153.85. That's the portions of the overall. Say, after you get out even 30, 40 years, the actual present values of each of these preferred dividends becomes very, very small. Right, so the far away values in the future are effectively worth 0. This in calculus is what's called a convergent series. You have an infinite number of payments here, but even with an infinite number of these, this preferred stock, unlike a bond, it never matures. A preferred stock can live on thousands of years, at least in theory. So it's weird for people when they think, well, I have the value of something that's going to be paid thousands and thousands of years from now, so the value must be infinite. Actually, no, it's not, because if you're discounting by a rate larger than the growth rate, right, and we're discounting by 13% here every period, as long as your discount rate is larger than the growth rate, and the growth rate of the preferred stock is 0 to the dividends, you actually have this series converge, and the math converges really easily to this number. There's the 153.85. But it's the equivalent. When I first pulled this open a minute ago, that was a mistake. I tried putting like 999, 999 sort of thing on here, right? On your financial calculator, that'll work, but on this website, it doesn't. So if you just put up an insanely high number of periods, you'll see that the value converges to 153.85. So much so that they say, like after the first 70 years, almost all the value, everything but 3 cents of today's value, is in the dividends that are coming in the next, excuse me, 70 years, right? Even though they keep going on infinitely. Right? Right? There you go. Right? That's showing you, hey, it says 20 of these. Excuse me. Here's an example with 1,000. You don't even need 1,000. It looked to me like after you get to about 150 or 200. Right? So you can kind of demonstrate for yourself either way. This website calculator is a little sticky. It didn't like it when I put an insanely high number in like 100,000 years sort of thing. But you can either use a darn large N like this to demonstrate what the value converges to, or you can use the formula directly. Of course, the difference here is that when you're using the financial part of the calculator, you put in the 13 as a percentage, right? Whereas here, when you're using the old school formula convergent series properties, this formula uses the 13% in decimal form. Right? Now, common stock, we've talked about a lot of this before. Common stock represents ownership, which implies control, and you want to maximize the share price, and you have the right to vote for your board of directors, who hires the CEO, and all this good stuff. Right, but we've discussed all that sort of detail of the structure of common stock ownership before. As I say, the real goal here is to talk about some valuation techniques for common stock. It's a little bit harder than preferred stock because the dividends for common stock tend to grow. So we'll use a dividend growth model. It's actually easier than that, might imply at first. It's a lot like the simple preferred stock model here where the dividends grow at rate 0. It's only slightly more complicated, the dividend growth model, but we'll address it here shortly. And then we'll do some extra wrinkles and stuff of it that allow you to consider some even, more funsy and challenging types of problems. And of course, as always, you got plenty of practice to go check out examples that we've worked, that sort of thing, to prepare yourself for the mathematical parts of this. There's also the free cash flow method of valuation, which requires more work, more input, more detail to do, sort of thing. And say, I don't have you do as much valuation directly with free cash flow methods as dividend growth methods here, but we can discuss at least some of the similarities and a little bit about using multiples as well as a comparison. But some of those are topics that are probably for more of an investment finance type of class. So we'll touch on that a little bit, but most of our emphasis here is the dividend sort of model with a little bit of commentary on the reason for the others. Right? Now you have subscripts on your dividends. Right? When we're talking about common stock, with preferred stock a minute ago, it was just D, 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 D in the numerator, yes? Now it's not. Now they have subscripts because dividends, common dividends, tend to grow. They don't just stay set at the same number every period, every period, every period. All right, well, what's the ramification of that? The ramification of that is it gets a little bit harder to deal with this. You can't just use this shortcut formula for preferred stock where the value is the constant dividend amount over the discount rate, right? Now you have to deal with this, and one thing that makes this a lot easier is if you assume the dividends are going to grow at the same rate forever, and we call that rate G, right? And say this one, to be kind of blunt with you, right? Like we said, the dividends here typically don't grow, they're typically flat. That's another way of saying that G is 0. Whereas here with common stock, we usually have a G greater than 0. Dividend for common stock tend to grow over time, right? But the rub with this is it's not really a G, right? You don't have a G until the growth is constant, is a word often used with these problems. I sometimes use the word permanent because it emphasizes that they're going to grow at exactly the same rate every period, which is identical forever. So this assumption makes the math really easy. I'll show you what it does to the math here in just an instant. But I really need you to kind of understand and respect the fact that it's a huge assumption. to say that your dividends grow at rate G is a very, very big assumption. It's super specific. Saying that they grow at rate G, like, and just for example, say that G equals, 2%. That means that if today's dividend was $1, right, the next period has to be exactly 102, right? And then 102 times 102, right? And it's like 1044, right? 1.044, I think. I don't want to screw. It has to grow at exactly that amount. I mean, it has to work out so that the math perfectly matches exactly 2% every period. So until your growth is truly permanent, constant, identical, you can't use, right, this G shortcut. It's a huge assumption in the real world because growth rates aren't typically perfectly identical from period to period, year to year, etc. But if they were, you'd have this lovely thing going for you. Right? You'd have this lovely reality, this equation working for you. It's just a little bit more complicated than the preferred stock version. In fact, the preferred stock version is just a subset of this. If your G was 0, right, if the dividends never grew, then they'd all be the same. You just have a D again, and then minus it. You would just be back to the preferred formula yet again, where P0 equals D over KS in our book's nomenclature. All right. This one's a little bit more complicated because now you have a growth rate. The growth rate's implication is what you'd expect, which is the more that your dividends are growing, right? If your G gets bigger, your denominator here, right, gets smaller because it's KS minus G. So the bigger the G, the smaller the denominator. The smaller the denominator, the larger the fraction value. So the bigger the G, the more valuable the stock. And that makes sense, right? The more your dividends are growing, the more valuable a stock would, of course, be. That's how it is operationally. It's really important to remember two things with this. The first is that this only works when your RS, or your KS, I should say here, is bigger than your G, right? Your rate of return must be bigger. But practically speaking, in the real world, that's basically always true. Rates of return on stocks are usually things like 8%, 11%, 14%, things like that. Growth rates of dividends are usually things like 1%, 2%, 3%, 4%. That's not a huge practical assumption or big deal, but it is necessary. If it weren't, then KS minus G could be negative, and you'd have this garbage answer where the stock price was negative. No such thing. Right? And then the other thing to keep in mind with this is that your KS and your G are, of course, always in decimal version. Right? Right. So if you have a 11% KS, that's 0.11, and a 3% growth rate, that's 0.03. Right? You have to use them that way to plug them in here. Right? And again, it would be a bupkis thing ever to have a growth rate, a permanent growth rate. Stocks might grow super fast in their dividends for a while, but you wouldn't have them constantly growing at a rate, permanently forever at a rate higher than your KS. That would never really happen, right? But that's, again, sort of a hat tip to the part where this formula only works, right, when you indeed have a permanent G. How do you get your KS? How do you know what the required return is on your stock? Well, one way to do it would be to use what we call the capital asset pricing model. Right? Some of you are more familiar with this off the bat before the class even started than others. Right? But this is one method by which to get the required rate of return. It says that your required return is your risk-free rate plus your market premium times your firm's beta. Right? The beta is a measure of how risky you are compared to the average stock or the average investment. So beta here of 1 is average, right? So say if some of you have forgotten a piece of this or hadn't seen it in a while, right? Beta of 1 is typical or average. So a beta of 1.2 is 20% larger than average. And the more risk you have, the larger your beta, the higher your required return is, right? You got to be really careful with the words premium versus market return. KM here is your market return, right? So KS, right, is your required common stock return. KM is your required market return. So it's not specific to any one stock, it's for everything in the market. And then there's a name for this thing here. This quantity is called the premium. So it would be identical in terms of this slide that I'm showing you to say this setup has a market expected return, required return of 12%, or a premium of 5%. When you quote a premium or write it down, you've already subtracted the risk-free rate in the calculation. And again, another thing to keep in mind is your KS, like in this example, might be 13%, but we already talked about this. When you go to plug it in, right, and use it in our formula attack that we just saw, it's in decimal form. So you might get 13% depending on how you write down the pieces of this calculation. But when you utilize a KS in the valuation scheme, you got to change from percent here to decimal kind of thing. I skipped a little bit past it a moment ago, but there's different kinds of problems with common stock and dividend growth models based on the timing of the dividends. Right? This shortcut method, right? And when I say this shortcut method for talking about common stock value, P0 equals D1 over RS minus G. Right? That's actually just a subset of the relationship. You could talk about the price at any point, and you need to know the next dividend over RS minus G. But I kind of brushed by it quickly last time. Sometimes you're told the current dividend, the dividend right now, the D0. Well, if you have the D0 and you need the D1 to execute this formula, you can grow the dividend from time 1 to time 0 by just multiplying by 1 plus G. Of course, again, you have to remember, keep in mind that your G, right, is in decimal form. And I keep using R because I use that in a different class typically, so I need to be on the ball here with y'all. I apologize. Right. Right. These things here, boom, boom, are the same. It's just that D1 is a future dividend, right? Right? It's to be paid in a period. Usually these are in years. And the D0 was the dividend just paid. Right? So just paid currently. And I usually think it's easier to think of it as if it just happened in the past, sort of thing. Right? So you got to be really careful. If you're told in this example that the next dividend is $3.50, then you get to plug in the $3.50 automatically. The denominator simplifies to 0.13 minus 0.06 or 0.07, and this is worth $50 in this case. You got to be really careful, again, keeping these in decimals, not percents. And you got to kind of also keep in mind this is a large fraction bar here. So to me, I kind of think of this as putting parentheses around the 0.13 minus 0.06. You need to make sure you do the subtraction in the denominator first before you divide. Right? So don't fall in the trap, say, with a calculator where you divide by KS first and then subtract the G. That would be wrong. A large fraction bar is the same thing in order of operations as implying a parentheses on the denominator. Now, if you're given one like this, where you're talking about a dividend just paid, right, and then you have to manually grow the numerator at one growth rate. So that would be, in this case, to multiply by 1.06, since the G on this example is 6%. Right? So that's the thing. Be really careful when you're doing these problems about kind of, making sure to know, what did you have a dividend 0 that's already been paid, or a dividend that's coming in a period to be paid? D1 versus D0 changes the numerator, right? whether you're not, and you just got to keep an eye on that. And in a word problem type of world, that really means keep an eye on your verb tense in many cases. Now, I mentioned a moment ago too, there's nothing magical about this relationship at time zero. This here is actually the mathematical quantity. This is the general form right here. So this relationship between the common stock price and the dividends, it's based on the price at any point you want has the next dividend in the numerator for the calculation. So it's most common to talk about the stock price today, since that tends to be something people care a lot about. But you can find the price 1 year from now. You just need a D2 in the numerator to run the numbers. Right? In fact, in this case, you can even sort of see that, oh, guess how this actually works. If I want to know the price that I expect 1 year from now, right? I can take this example from slide 15. The price today, my best estimate is $30.29, but I expect the price will grow to $32.10 next year. Right? All I need to know for my price estimate 1 year from now, DP1, I need the next dividend. So it's D2 in that case, because the next one is to period 2. The KS minus G is the same denominator. The hat on the P, the little thingity do there, is to let you know it's the expected, your estimate of the price a year from now. That's the reason for that little abbreviation that you sometimes see. Right? There's even more detail to this too, which I believe the book spells out even better. What you actually have, right, is you have more detail about how you're going to earn the 13%. 13% is your expectation of what you're going to make by owning this stock. Well, how are you going to make 13%? You expect to make a $2.12 dividend, and you expect the price to go up from $30.29, right, to $32.10. So if you get really bored here and you want to go even more into detail, right, you can show for yourself that going up in price from $30.29 to $32.10, adding on a $2.12 dividend, this is another way of getting your 13%. That's not an accident. Sometimes we'll have problems where you're going to be asked to solve for your required return. And if you're not given CAPM type data, if you're not given data about betas and premiums, right, and risk-free rates like this example on slide 13 does, you might be able to use our dividend framework and work the other way. If you solve this entity here, right, for the KS, you get this expression. And yet again, this doesn't actually have to be based on time zero, right? It can be based on any point in time. It's just that time zero is by far the most typical time at which you would gather and use this information, right? So to me, this is just saying, hey, multiply both sides by KS minus G, DN plus 1, right? Divide both sides by PN to clear that off, right? And then add the G to both sides to get this expression. But one of those special cases is, of course, times 0 for P and 1 for D. And again, realistically speaking, those are the time values which you have the most often to execute this sort of thing. We have some problems. You can do problems that have a lot more work to them. And one example would be the supernormal model. The supernormal growth instance. The supernormal growth dividend situation is one where the dividends of the stock don't have a G at the start. They only get a G later, right? Now, to me, you've got some of the detail here in your slides, but in the supernormal case, right, the dividends, the common dividends here we're talking about, they're the only ones that grow. They grow fast at the outset, and only later, right, do they settle to a true permanent growth rate that we call G. Well, the problem with that in terms of doing the valuation, the math, is you can't use our shortcut here, right? You cannot use this shortcut, hey, say here, to get the value today unless you have a constant G right off the bat. Well, what if that's not the case? What if you have a supernormal instance? A lot of times in the real world, you'll have stocks that start paying dividends and they accelerate. They're very fast, the growth of these dividends at first when they begin paying, and only later do they settle into a more stable type of growth. Now, mathematically, you can think of it as this, but typically that, well, not that y'all can't handle it, but sometimes that equation sort of scares people. It's just too much to sort of think of it this way. All this is saying in words is that, hey, what happens if you have an instance where the dividends are growing fast for a while? Well, in that case, you need to get the present values of the dividends that are kind of special cases where the growth is fast, and only when the growth becomes permanent at time n in this case, do you get to take our shortcut. This thing over here looks a little familiar, yes? This here is doing the shortcut where we can get the value in the future based on the next dividend, right? So the value at any point you want is the next dividend. So dn is the time you want, and grow it one more to get dn plus 1 in the numerator, right? And then you got your typical denominator, and then you have to take it back to the present. Now say, again, this sort of thing tends to scare people more because of all the symbols and such and summation signs. Sometimes it's easier to see this with an illustration kind of thing and a sample practice problem sort of thing, if you will. So I think we should probably do one of those, right? So in words, what are you really doing? You're going to get the special dividends, the ones where the dividend is growing fast for a while. You're going to get those exact amounts. And then once the growth kicks in, the permanent growth, the G kicks in, then you need to get one more regular dividend. That, in so many symbols, is this here, the dn times 1 plus G. You need to get the first regular dividend where the permanent growth rate G has applied. Then you need to get the present values of everything. You get the present values of the individual supernormal cases one at a time, just using your time value of money tools. And then you're also going to use our shortcut, but you're going to use that Pn equals dn plus 1, that general version of the formula. You're going to use that to wrap up your work, right? All right. So for example, what if you have supernormal growth of 30% for 3 years, right? Your last dividend was $2. That's the verb tense telling you that the dividend just paid, D0 is 2, right? After your 3 years of 30%, your growth rate becomes 6% forever. If I give you a KS, a discount rate of 13%, how do you deal with this, right? Now, this tends to scare people at first, but it doesn't have to be so. And say, when we talked at the start here that some of these would stretch your legs and, right, get you doing some new wrinkled calculations, what I mean is something like this where, oh, okay, we just paid a $2 dividend, yes? Well, what's the 30% growth for 30% growth just means multiply by 1.3, right? That's what I have here for you on the next slide. So 260 would be your next dividend, then 338, then 4394. So I'm not going to do the dollar signs because it clutters the screen, but 260, yes, and then 439, is it 338, excuse me. Right. And then 439.4. You need those dividends. Okay. And then I always tell people when I do this, I like to show folks one more regular. Now this is a little bit different than how your slide here at the bottom of the slide, but I like to do one of the G's of 6%. Well, your G kicks in after 3 years here, so you multiply by 1.06, right? What's 4.394 times 1.06? Right? I say that, and I don't have the answer directly in front of me. Let's go ahead and find it out. Right? 4.394 times 1.06 is 4.658. Right? So if you want to know the value of this stock, I want to use this formula at the first chance I get. Pn equals dn plus 1 over ks minus g. But the first chance I get is right here at time 3. Well, what do I have to do to get that? Well, I got to multiply 4.394 times 1.06. That's my numerator. That's what's here on the slide. But say I just looked it up or calculated it with you, and we know that that answer for the numerator is 4.658. What's the denominator? 0.13 minus 0.06. It's the same easy shortcut as ever, right? That big thing is we're $66.54, right? That's the number here. Well, what the heck is 66.54, right? It's the value of dividend 4 all the way through dividend infinity. It's all the future dividends at time 3. Why time 3? Because that's the point at which this formula, right, was used. So how do I get the present value of all the dividends? I need the present value of 260 and 338 and 439.4 at times 1, 2, and 3. And I also need the value of this number, right, that's at time 3. How do I do that? Well, you can get each of them individually by discounting by 13% squared, cubed, and then this one also cubed, and get all the numbers, right? Or you can use the NPV part of your calculator, right? You can make, right, your cash flow 1, 260, your cash flow 2, 338, your cash flow 3, you have to combine. If you have to, since those both are at time 3, both the value of the dividend there and the big lump sum for dividends 4 through infinity, that has to be added, and you get $70.90 or so for time 3. Use 13% as your discount rate. You have to use a 0, a placeholder there, right? There is no, that $2, right, just paid, that's a reference point by which to construct the future dividends, but this $2 is not part of the value. It's already paid. So if I'm talking about what is this stock worth, you don't count dividends already paid if you're looking to value a stock, because if I was going to buy it from you or sell it to you, I wouldn't also give you the dividend that I had already gotten. So the 0 there is a placeholder for that reason. When you spit out an answer here, right, it's $54.11. Of course, you can use the cash flow registers if you're talking about using a BA2 plus or an HP 10B2 or whatever. Right? Alternatively, sometimes you don't have good dividend information about a company, right? So sometimes you want to use a free cash flow method instead. A free cash flow method is more cumbersome. It takes more information in the real world if you're looking to calculate a free cash flow, right, than just having dividend estimates. But the good thing about this is a free cash flow estimate is less sensitive to wacky things with dividends. They're both very sensitive. Free cash flow methods and dividends are very sensitive to the inputs and assumptions that you use. But in the dividend case, it's all about the dividends, though. And in a lot of cases, firms don't even pay dividends, or they're not projected to for many, many years. That's a really typical time where a free cash flow method is used to value companies. But the free cash flow method in the real world, for those of you that do some more investment finance and stuff, tends to be kind of the ultimate, kind of like the gold standard of valuation. It's just more involved, right? It's not super involved in a textbook case because we can tell you a lot of assumptions that make the work digestible in a problem like we will do here in just a moment. Right? But in a real world case, it becomes somewhat more complicated, usually a lot more complicated, because to estimate free cash flows requires a lot more information, a lot more pieces than just estimating future dividends. They're not that different in a textbook setting because I can just tell you free cash flows in a book problem the same way that I can tell you dividends in a book problem. The big difference with free cash flows is since you're dealing with free cash flows rather than dividends per share, right? Quietly, all of these dividends that we were talking about were dividends per share, right? I hadn't said that all chapter long really, but $2 dividend per share. I mean, even back to our preferred stock and stuff, all the way back here, we were talking about $20 dividends per preferred share. We were talking about free cash flows. You might not see them quoted per share. Well, that means at the end of all this work, you need to take the dollars of cash flows that you're estimating and divide by the number of shares so that you can come up with a price estimate per share. The other thing is, when you're dealing with cash flows projected, you also need to worry about paying off any debt or preferred stock values before you're left with cash that can be shared amongst the common stockholders. So more detail on this, of course, in the full text, but that's the gist of this. And how does that translate? It translates to a practice problem like we're going to look at here in a moment on slide 28. Now, again, I don't have as much of these type of free cash flow method problems for you to worry about as I do dividend growth model problems, but it is something to be a little bit ready for. Right? A lot of the work is going to be the same in a textbook world because I can give you the same sorts of information. You're still going to have an assumption at some point where the growth rate becomes permanent. But of course, in this case, when you're dealing with cash flows, you're no longer talking about a dividend increase being at a constant permanent rate of G. You're going to be talking about a cash flow increase from one period to the next, always being at a permanent constant rate of G. But the same sort of attack is going to apply here, and you'll see that again in just a couple slides as we start the example. Right, it's not that different in a book setting. It's considerably more complicated, typically speaking, in a real world or empirical setting, something some of you will see it eventually, or if you haven't already. But a lot of the procedure is there are some differences, of course, like when the dividends are replaced by free cash flows, you can have something like a negative, no such thing as a negative dividend, right? But you can have a negative free cash flow. Another one that I kind of was quietly slipping by here at the bottom is when you're using the dividends, right, as the basis of the valuation, then it's the cost of equity only that is the appropriate discount rate to use. When you're dealing with free cash flows are used to both pay back debt, right, and buy back preferred stock, as well as to value common stock. That's a long way of saying that when you're only dealing with dividends, we were using KS, right, in the valuation here. That's the discount rate. And KS is only relevant, it's only the return on common stock. When you're dealing with free cash flows, you use the weighted average cost of capital, or the cost of capital, which takes into account not just the cost of common stock, but also preferred stock and debt. Right? Typically speaking, it's not surprising really to see a cost of capital that's a little less than your cost of common stock, because common stock is usually the most expensive type of capital. We have talked about that already before. Okay? Well, what does this mean? All right, this means that if I was drawing a picture and I was going to do this new problem, I would probably do this new problem with an eye on, oh, okay, I have expected cash flows for the next few years of -5, right? But then a big jump to 10, and then a doubling, 100% growth to 20, and then I get a G kicks in. Only then do I have a G for the first time of 6%. That's when I have a permanent growth. 6% over $20 is $21.20, so I'll just go ahead and pencil that in right there. And if I'm looking to come up with a value here, right, in this example, I'm basically going to do the same attack, right, as I did in the last example. I'm going to get the present value of my -5, of my +10, of my +20. You can use the NPV tool when the time comes, and this time 10% is the cost of capital is the correct rate to do this by. Right? So you can do them individually like this, or you can do them all simultaneously by using your NPV tool correctly. Now, yet again, you have a value, a horizon value or horizon price at time 3 that has the next free cash flow. And this is the first chance you get to invoke this formula. Now, it says KS on the slides, but that's, say, you can do cost of capital, or you could, or, you know, we've been thinking of it as KS. So if you're looking to be analogous, you can say KS to keep it clean and simple comparison. Right? But you can only, this time 3, this is the first time where you can use, right, this shortcut. So we were biding our time, right, and individually considering the cash flows until this magical time, time 3. So at the first chance we get, we use this shortcut. That's what gives you the piece right here that's 530. Right? And like last time, what the heck am I getting from the 530? The 530 is the value at time 3 of all the future cash flows from time 4 to infinity. That's a lot, right? That's everything past year 3. Time 4 all the way through infinity. Those cash flows are worth 530. But they're worth 530 at time 3. So when it comes time to getting the final answer to this, you need to discount that back 3 periods. Right? Now, of course, 530 plus 20, both of those numbers are at time 3, so the grand total is 550. Right? Which is to say, if you're going to use your calculator to do this, and you're going to use the NPV shortcut, you need to put in 0 again for the first cash flow, because the cash flow already generated is not part of the calculation here. Right? So 0 is a placeholder. -5 and 10 are your cash flows at times 1 and 2. 550 is the big cash flow at time 3. Use 10 as your discount rate. You got to plug them in the same way when the cash flow register of your BA2 or HP 10B2 plus, or you got to use the same braces and such method here, right, to get an NPV. So the 10 would be the first number, again a 0, right? And then you'd have, right, those 3 values. What were they? Right? -5, 10, and 550, all in the braces separated by commas. And of course, you can again do this, right, with a cash flow register on a 1-line calculator as well. This is talking more, right? The braces and stuff up here was talking more about your graphing calculators. Right? There's a little bit more to do though. You're not quite done, right? If you have a cash flow setting. In a cash flow setting, again, remember your cost of capital was based not just on common equity, but on all types of capital. That's why it was 10% instead of 13. It was based on debt and preferred stock as well. So if you have any information about debt or preferred stock, you have to subtract out the value of any debt or preferred stock. You have to repay, for example, $40 million of debt here before your common shareholders can all split the proceeds. So you take your $416.94 here and subtract 40, right? Your $417 million of present value free cash flow, you actually only have $377 million to distribute amongst the shareholders, since you have to repay $40 of debt before we can split the proceeds. Well, now you divide by the number of shares to get the value per share. If this was in millions of dollars, and you have millions of shares, then the millions cancel and you can just do 376.94 divided by 10, and you're left with a stock price estimate per share, $37.69. right? A little more complicated, and I'd usually have more questions about the dividend versions of these rather than the free cash flows. But it's not that much of an extra wrinkle to handle, especially with some practice. Right? A couple things about efficient markets. This is a big personal area of interest to me, so I can talk ears about this, but just some ideas for the book. I usually have some concept question stuff that I green light, for graded items and stuff about the efficient market hypothesis. It's the idea that prices are fair, or they're in equilibrium, right? That is to say that if I come up with, right, a price of $37.69 and it's all based on completely true. Now, of course, the devil in really doing valuation is knowing what things like future cash flows are going to be, right? But just say, for example, we all agree that those are the correct estimates of our inputs in this case. Well, that means the price out there in the open market today really will be $37.69, right? Our estimate of the price will match the actual price in the market, and that idea is called equilibrium. How that actually manifests itself in a real-world setting is that you come up with an estimate for something like $37.69, and you compare it to the real price. And if the real price out there is higher, you probably avoid that stock because you think the real price today is too high. But if the real price today is like $34 per share, maybe you go buy some because you think it's really worth more than it actually trades for. Right? That's a big real world implication of how stock valuation works in an investment context. Right? But from a bigger conceptual point of view, the idea here would be, the actual price today matches the correctly valued price in the future. And that concept is the idea of being in equilibrium. That's a conceptual thing that you want to know. And going hand in hand with the idea of equilibrium is that if prices are indeed correct, right? If the price is $37.69 today because that's the actual correct value based on correct inputs and estimates of the future, then you can't beat the market by buying it or selling it at $37.69, which is to say the price of $37.69 is exactly right. Now, of course, we're skeptical of that sort of thing because we know that stock prices, people make lots of money and lose lots of money by investing in stocks all the time. Right? So this is more of a kind of a benchmark, an academic sort of idea, this idea of equilibrium. But it lends itself to sort of this application, this discussion of weak form, semi-strong form, and strong form market efficiency. Those are concepts, and again, more detail as always in our full text, but those are things you want to be ready for. Those are concept type items that I green light with grading sort of thing. Weak form efficient market hypothesis basically says, hey, I'm not going to be able to beat the price, right? If the price is today $37.69, right, I'm not going to be able to look at past trends, and in particular, right, with weak form efficient market hypothesis, we tend to think of numerical type data, like what the price itself has done in the past. Right? Weak form efficient market hypothesis says, right, is usually tied to numerical type information. Right? I should say that too for you. The weak form, right, can't use numerical info and especially trends in the price, right, to beat the market. Some people still try. It's called technical analysis. This is things, and there's all sorts of stuff on the internet if you just, search for even videos on things like using a charting technique, or trying to think of I don't do much of it myself, but try to think of names for, right, like different things where the price rebounds after the third time where it touches an asymptote, it breaks through on the third trend. Those are weak form efficient market hypothesis things, and Say the idea being that, again, you cannot beat the market based on just looking at numerical information about an investment from the past. The semi-strong form of this incorporates not just numerical type information, but any information. If there's information out there about General Electric, right, and not just things like what was GE's price yesterday, last week, last second, last month, right? Those price things are more like weak form, but also things like what are the sales trends? Where are they opening new factories? What are they doing with their employee benefit? What is their new CEO like? Anything that's publicly available is automatically correctly taken by the market, by all investors, and reflected into the price to update your future free cash flow estimates. Right? So at any time that there's any information out there about a stock, whether it's about, again, leadership and management, whether it's about revenues, whether it's about prices of the stock and how it traded recently, that's more tied to just the weak form, right? Anything about this stock, everybody out there immediately knows, right, how to update their free cash flow estimates for the future. And as you update your free cash flow estimates instantaneously and correctly for the future, right, the price correctly moves with it, and you have a new accurate price estimate. Now, of course, in the real world, that's way overstating things. Really talented analysts are capable, indeed, of picking stocks that are going to go up or avoiding stocks that are going to go down. Right? But to do so, they have to beat the semi-strong form efficient market hypothesis, and that's hard to do. It's largely true that information is tough to trade on, especially in the modern age where breaking news happens fast and everyone has access to very quick technology with which to buy and sell assets. Right? The extreme version of the efficient market hypothesis is the strong form efficient market hypothesis, which states that even if I have inside information about a stock, all information that's out there is immediately priced in to the future free cash flow estimates. Not just publicly available information gets immediately updated in these and therefore reflects in the price. Right? Not just that, everything. Well, that's not true. I mean, if you were, say, working in the laboratory at a drug company and were one of the first to know about a new drug and you were to go buy shares of your company and stuff, that sort of thing is illegal for a reason. Using non-public information to front-run trading, either to ditch or avoid, avoiding is okay, but to ditch a stock that's about to go down or to buy a stock that's about to go up, it's illegal for a reason, because the strong form efficient market hypothesis doesn't work. Somebody somewhere has to make the information public, which then quickly gets reflected in the prices. Right? But when an insider does it, that's illegal, and that's because the strong form efficient market hypothesis isn't true. Somebody somewhere has to actually make money, right, on information breaking. Right? Overall, I'll say this is something I study with all sorts of specific examples, but try not to get too deep in the weeds here. I do think it's important that you are ready for those forms and questions about the concept, questions about those efficient market hypothesis things, but I'm trying to keep it in a somewhat small space without going too crazy on it. Right? It's very hard to beat markets. They're highly efficient in the weak form, just using numerical trends. They're somewhat efficient, harder to beat in the semi-strong form, and they're not efficient in the strong form. Insiders can and do make abnormal and sometimes illegal profits. And there's some gray areas to things like that too. But as you know, or you remember from news things, people do go to jail sometimes for that sort of thing. Right? But prices are not always perfect. And so an area of study for those of you that are interested and more just into finance instead of just kind of general business sort of items is behavioral finance recognizes that human beings put weird values on certain things, right? Or they might overly discount the values of some things or overly like the values of others. Right? And so that can drive you into places where the actual trading prices at any point in time don't really match up with the best estimates in the future. So knowing more about that has kind of become its own area of study in recent times, and so it's something that a lot of us find pretty interesting.